The official economic numbers confirmed what American households already know. Prices continued to rise in September. According to the Consumer Price Index report released Thursday, prices increased 0.4% last month. That's a faster rate than August's 0.1% reading. Overall, inflation climbed 8.2% in the year through September, higher than economists had predicted. For more on all this, I want to bring in Ben Levisohn. He's a deputy editor at Barron's. Ben, what do you see inside this data?
This data is just, it's a really tough one. It's showing that there's very few signs of inflation cooling down. There was some good news in it. Gas prices are down. Used car prices, which we remember had gone up so much, those have started to come down. And clothing prices, apparel, that's come down as well. But you look at pretty much everything else. It's a problem. Grocery prices are going up. The way that the economists measure the rent and whatnot, that's gone up a lot. And it's so broad that it really indicates that there hasn't been a cool down in inflation just yet. One that many people were expecting to see at this point.
Well, yes, there's a lot of expectation missing here. But before I get to beating up on the expectation predictors, the Federal Reserve has already promised to raise rates. Do you think this will make them do it more? And does this ensure that this idea of a managed reduction of inflation, a so-called soft landing, is an impossibility, that inflation is just too protracted?
It's not necessarily an impossibility. The Fed is going to raise rates almost certainly by 0.75 of a point at its next meeting in November. And the hope was that it could start tapering those off, that you could go with 0.5 point and then 0.25 of a point. And I think those hopes are pretty much dashed with this report. The market's now expecting another 0.75 November, 0.75 after that. And it actually thinks that the rate could get as high as 5%, which is much higher than anyone really thought if you go back even just a few months. I'm not sure about the soft landing part, though. It does look like that the odds favor a recession. But there's still that chance that because the economy is as strong as it is, that you can end up with a soft landing, that it can handle some of what's happening with the Fed rate hikes right now. But we have to remember that the rate hikes, they slow the economy. They take a while to do that. They could take anywhere from 6 to 12 months before those rate hikes actually have an effect. So we're really not going to see evidence of this for another few months.
So back to this idea that inflation was once again hotter than expected. If those who are making guesses about the economy keep getting things wrong, which means their policy responses are going to be misses, is there a cumulative uncertainty that attaches to all of this compounding error?
I think there is. One of the things that I think we were all used to for really the decade leading up to COVID is that there wasn't a lot of volatility to the economic data. Growth wasn't fast. It was actually quite slow, but there wasn't a lot of variation to it. We were very used to this growth that was very close to 2%. Inflation wasn't high, and there were hopes that growth could pick up, but it never really happened. What we're seeing now is that it's harder to predict what the economic data is going to look like. Things that we used to be able to count on aren't shaping up the way that we once expected them to. And I think that makes it very hard for policymakers and really gives the Fed no choice but to keep doing what it's doing. It has to stick to its guns. It has to decide that, it has to keep going with these rate hikes until it does see signs that inflation is coming down, because that is really the most important thing for it right now.
And finally, Ben, we have had often the experience where bad news in one context elicits good news in another. And that leads me to a question about the stock market, which had a very strong day today. What's your assessment of why that was the case?
I mean, that left everyone kind of befuddled, myself included. The initial reaction from the stock market was exactly what you would have expected. The market had been up before the release. The futures tumbled very quickly, and the market looked like it was heading for a very massive sell-off. Instead, it rallied. I think there were a few reasons that people pointed to for that. One is that earnings during the day, companies like Domino's Pizza and Delta Airlines had come out, and they actually given good guidance, saying that their profits and sales would be strong going forward. And then you had also just the fact that everybody has been so scared of this market, so scared of what happens if you do get a hotter than expected inflation print, that it's very possible that everybody who needed to sell had sold. And we hit some what we like to call technical levels. These are what the chart watchers look at, but the machines are trading on them. And you hit some of these levels, and all of a sudden you can get a bounce that takes on a lot of strength that might not have been expected.
Another unexpected event in our economy. Ben, thank you for helping us sort through all of that. Ben Levisohn.
Thank you, John.